It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the Tax Lady, and this is our hour to talk taxes. And what we usually do a couple, 2-3 times a year, maybe 4, 5, maybe 6. Anyway, we have a show dedicated to your emails and the things that you email us all the time. And this way, we have an opportunity to really chew up the tax law and make you understand maybe a little more about taxes, how the law is written, some of the options in the law. And that's what today's show is all about. And so we're not going to be taking live phone-in calls, but next week we'll be back in studio, of course, taking your phone calls. But today is strictly email day, and I have Chris Fabian, my vice president.
Hello, Esther.
And Tiffany Fabian, my other vice president.
Hey,
and they're
there,
related
Esther.
To each other.
Yeah, imagine
Fabian.
that.
The Fabian.
He's my other better half.
But everybody that is our clients and listen regularly have heard Tiff and Chris on with me because they do the show with me.
That's right.
And of course,
And
I'm
it's a
Esther
pleasure.
Gulius from EG Tax, right? And tax season's over, and we're going to talk about things that are not only tax related but financial related because obviously taxes affect every part of your life. But the bottom line is, it isn't so important. I mean, the taxes you pay are important, but obviously, you would never give up money to save, make a deduction.
Paying
Would you
the
agree?
right amount of taxes is what's important.
Right,
You don't want to
because-
pay too much.
Or too little. But the thing is, what people don't realize is, I don't think, is that, for instance, people will say to me, I'm going to not work overtime this week. Because I'm not going to pay 40% in taxes. And would you agree with that, either of you?
No.
Well, I agree. We hear that all the time.
Right.
I would
Do
not
I agree with
with
that
it,
statement? No.
Because why?
Because it's not true. Because your tax brackets is determined by your income, and if you're over from 25 to the 28% bracket by $1,000, only that extra $1,000 gets taxed at
And
28%.
nobody knows that. None of my clients do that. So I actually pull out the brackets and I show them it's the amount that lops over, not much, that is taxed at the higher rate. Oh.
But the
and
bottom
light bulb
line
goes
is,
off.
when you take a look at the taxes you actually paid, divided by your total income, that's what your marginal tax rate is.
Right.
Most people that are paying taxes are probably at the 12%. So when you take a look at making an extra $20,000 a year, yeah, it's true that you're going to pay an extra $2,200 in income tax, but you made $20,000 paying $22,000. So you would never give up the money because of the taxes.
No. And then also another one that I hear quite frequently is, I'm going to get a mortgage because then I could write off the mortgage interest. And I'm like, hold up. The amount that you're going to pay in interest is far greater than the tax savings. So that's not the reason you want to get a
Right.
mortgage.
So if you're somebody that can pay off your mortgage, you are smart. Financially, you're smart.
Correct.
Because you may pay slightly more in income taxes, but financially, you save the money. For instance, let's say that your house payment is $1,000 a month, right, in
Right.
principal and interest, all right, which is $12,000 you're shelling out every year, right? And let's just say that half of it, $6,000 is interest, $6,000 is principal, and you're in the 10% tax bracket. What are you really saving in taxes?
Well, if you're in the 10% bracket, probably nothing, because there is no tax. There's no income left to be. I mean, there's very little. So, in essence, you could save, the most you'd save is $600.
$600. So you're paying $12,000
Right.
to save $600.
That's
so
not a good plan.
here's the thing. It's like, if you have to have a mortgage, then the
Right.
great thing is they're going to give you back some extra taxes.
That's
okay?
right.
That's the bottom line. But the bottom line is, if you don't need it, then don't spend the money, because It doesn't make any sense. Look at Donald Trump isn't saying to people, "Oh, I don't want to make billions of dollars because I don't want to pay taxes." The truth of the matter is, this guy's paying a ton of taxes, but he's making a ton more in income. Whenever you can make income, that's better for you.
That's right. That's right.
Right?
Yes.
Wow, that was a
You know-
long-winded start.
But yesterday, matter of fact, I was in the car with my daughter, my youngest daughter, and she goes, "Dad, what does the flat tax mean? How does it work now?" Because in their school, these 16-year-olds, they're really into this politics, what's going on.
Which is great.
Which is great. And so she goes, "What's a flat tax?" I said, "A flat tax is 10%. We'll say that's what's been going around." And she goes, "So what does that mean?" I said, "No matter how much you make, you're going to pay 10% of tax." And she goes, "But isn't that how it is now?" I said, "No, now it's based upon your income. It starts off at 10%, then it goes to 15, 25, 28. I said, the more you make, the more taxes you are.
The higher rate.
The higher rate." And you could see her mind going. And she goes, "Well, then why do they say that the rich pay no taxes when their tax rates are higher than everybody else's?" I said, "Exactly." I said, "But that's what you can manipulate everything to how you want it to be." And that's where we're saying about with the mortgage interest,
Right.
when it's worth it, when it's not worth it. You got to look
That's
at the
when
whole.
tax planning comes
Yep.
into play. It's like I was just talking to somebody before we got on air, and the person said to me, "Yeah, I'm thinking about buying a rental property next door. Would that be good for me?" Now, that's tax planning. Is he going to go into debt to do it? Yes, he's going to go into debt to do it. But the bottom line is he'll be able to depreciate the property. He'll be able to take some expenses on his own property. Going to Home Depot is going to be deductible. But the bottom line is this extra investment, when it appreciates, assuming it's going to appreciate, is going to save him more. It's going to make him more wealthy in the end.
That's
Plus, save him a little money right now every
Yes.
year.
Yep.
So for the person who likes just the lake smooth, they just want no ruffles in their lake. They want no waves in the water. Then going into a rental property, going into a small business, maybe getting a more expensive house wouldn't be something you'd want to do because you like it nice and smooth.
Yeah.
Well, you're going to get no tax benefits, right?
But a lot of people who want to get a rental are people who make quite a bit of money. And so it's also important to have that conversation. If you make a lot of money, they start taking away the ability to
That
use
is true.
the loss.
If you make more than $150,000, or if you're married filing a separate return, you don't get any rental
Right,
losses
right.
at all. They just suspend them
Right,
all.
they're
And
rainy
again,
day.
there's another example how the wealthy really don't. They're wealthy. There's no doubt about it. But if you consider $150,000 wealthy, but the bottom line is the federal government takes away the deductions once you hit $150,000 if you have rental property, unless you're a real estate professional.
That's right.
Right.
Okay, but anyway, so today's show, if we were talking and talking, we want to talk about the emails that we got, and this is what's so great. And you get 3 enrolled agents here who really know the tax law, and we'd like to impart what we know to help you with your finances, because it's not just about taxes, it's about your finances, your bottom line.
And that's what our whole summer series is about,
Your
is getting
finances.
everything in order.
Right.
Because it all comes back, unfortunately, to your tax return.
That's exact, because everything that you do affects your tax return. So why don't we go quickly here before our break? You got a
Yep,
quick question?
I do. I've got, this is Sarah. Esther, I am self-employed and I usually have a net profit of $45,000. One of my vendors asked if I was a corporation. Is this something I should consider? And so Sarah asks a really good question. I know I'll start and chime in. When you're incorporated, it's protection. And so if any of your, you worry about your personal assets, the nice thing about incorporating is that you have that umbrella of protection that surrounds you.
All right, and you know what? We're going to go into that. Why don't we take a short break, and we're going to really chew up being self-employed, limited liability companies, corporations on the other side. I'm Esther Golias from EG Tax. We'll see you on the other side. Okay, we're back from the break. I'm Esther Golias, the tax lady from EG Tax. And just before the break, Tiffany had read a question about somebody who is self-employed, and she wants to know whether she should incorporate. Chris, explain some of the difference these are called different types of businesses. And so there's a sole proprietorship.
Right, which Schedule C goes on your tax return.
Right. And this is what sounds like she has,
That's
right?
correct.
And then what other option would this lady have?
Well, there's an LLC, a single owner LLC, and for that has the umbrella of protection, like Tiffany was just saying, which means if you get sued, only the LLC gets sued, not you individually, as long as you didn't do anything fraudulently or willfully. But that gets taxed the same way as a self-employed person.
Schedule C.
A Schedule C. Then there's a C corporation.
So this lady, could move to a C corporation.
She could. And a C corporation has that umbrella of protection that we were just talking about, but the C corporation pays its own taxes. So if she's at $45,000 profit, the C corp at about 30% would pay about $15,000 a year to the federal, not to mention New York State. And then since it's her money, if she were to just write herself a check,
that would be considered a dividend.
Would be, yes, considered a dividend. So then she gets taxed on
Again.
that same money. So that's where the double taxation.
And that's on a C corp.
On a C corp.
But anyone who's a C corp
has an
election that they can make. Not anyone, but there's some limitations. You can't have a whole bunch. You can't have foreign investors. You can't have like more than 45 shareholders, et cetera, et cetera. But for most small business corporations, if they make the election to become an S corporation, then the double taxation stops, right?
Correct.
That's right.
Because the income will flow through to your personal return as ordinary income. The only thing is you would have to start paying yourself on a payroll, so you get a W-2. So then you're still paying the Social Security and Medicare tax, but you just have to pay yourself a reasonable salary. You don't have to pay yourself the whole net profit if you don't want to. So if you $45,000, you could pay yourself $30,000, have $15,000 out there. That $15,000 flows through as ordinary income, and if you want the money, you can write yourself a check, and you already pay tax on it prior. So then that money's basically, I don't want to say tax free, but in essence,
it saves you the FICA. And especially now, the whole thing is, if you're a single owner 1120S with no employees, all right, single owner with no employees, then it's kind of hard to say that you didn't make all the money. Right? So this is especially desirable if she's going to have outside salespeople. In other words, so that net profit, you can say, yes, is made by me and for other people.
Right.
Then it would make a lot more sense that the net profit wouldn't be subject to the FICA.
Correct.
Right?
Yep.
So, but either way, all three of those vehicles, whether it's an LLC, a C Corp, or an S Corp, all protect her from lawsuit.
Which is
which would make a lot of sense. Now, unfortunately, or fortunately, right now when she does her tax return, she just put that Schedule C on her tax return. If she was an 1120S or an 1120, then she would have to file a separate return, which would be in a corporation, and then the dividends either flow through on the C Corp or on the 1120S. She gets a K1.
Correct.
Okay, well that answered that question.
And it almost sounds like when the vendor asked if she was a corporation, that's probably because if you pay somebody more than $600, an individual, you have to mail out a 1099 miscellaneous. Right. So, but if she was a corporation,
then they wouldn't.
That vendor wouldn't have to. That's, Sarah, going back to why they asked if you were a corporation.
Right. All right. What other questions we got here?
I got Brian, and he says, Esther, why this year was I not able to claim, oh, my goodness, my rental loss on my return? On prior years, I was always able to. Well, this is sort of funny, Brian. We were just talking about that at the preliminary topics of the show, and that's because if you make a lot of money, probably over 150, as Esther says, you're disallowed to claim the loss on your tax return. There's suspended losses, or another way of saying rainy day losses. And so it sounds like you're in that category where you made a lot of money, and so those losses became suspended and you couldn't claim them. And
now, but there is a way around it. If Brian has a wife,
right,
or a partner, and the partner is a real estate professional,
correct,
then
That's not a real estate agent,
But a real estate professional.
which means someone who
many
spends.
times it is somebody that's a real estate agent as well.
It could be.
Could be.
Yep.
Who spends, I believe it's
900.
900 hours a year,
Yep.
taking care of your rental properties. Then the $150,000 income limitation is set aside, and you're allowed to take those losses because your spouse, your partner, or yourself is a real estate professional. My brother
Right.
is retired, and when he was working at Ford Motor Company, even though he had 25 houses, he wasn't considered a real estate professional because
His main source of
his main
income
source
was
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 Ford
his
Motor
job.
Company. Now that he's retired, all he does is take care of his rentals. And he just got remarried because his first wife passed away. He just got remarried, and they have an income restriction on their income, and they wouldn't be allowed any rental losses. But in his situation, because now he is a real estate professional, he's allowed to take those losses.
Yeah,
because he spends thousands of hours a year taking care of his rental properties.
And so that highlights another point is if you make too much money, a lot of times it is disallowed. A lot of times, also if you do married filing separate, they disallow that loss on your
Again,
rentals.
right.
However, as Esther says, if you're a real estate professional, that would be a horse of a
it
different
trumps
color.
that. And I think that's, when we're a lot, everybody's talking about how complicated tax law is. This is just an example of how complicated tax law is. You're allowed a rental loss, okay, up to $25,000 if your income's under $150,000, unless you're a real estate professional, and then those you're allowed to take the rental losses regardless of income, or unless you're married filing a separate return, unless you're a real estate professional. So that's what's so difficult about the tax law.
and the losses aren't lost. Okay, don't want to confuse you.
I mean,
there.
if you had suspended losses.
If you had suspended losses, they're just that. They're suspended either to your income drops down, to you sell the property, or you file a joint return, and depending on your income. So they just hang out there ready to be used. They're waiting like a bullpen pitcher in baseball. They're waiting to be called upon,
Yeah.
but until they qualify, you can't.
Right. Okay, do we have other question?
I've got Donald, EG Tax. I have some money in the Bank of Montreal for when we travel to Canada. I really can't take it out now because of the decreasing in exchange rates. It's only $12,000. Do I have to report that savings account? And that's Donald from Niagara Falls.
Well, what you think, Chris?
Well, first of all, two-part question. Any interest it's earning, you do have to claim
On your federal
on your
return.
federal return and your New York return.
Right.
Okay, it has to go on your return. So on $12,000, probably not getting a lot of money, but still, if it's $1, $5, $10, it's still got to go on your return. The thing in
The
question,
big problem
the big
is-
problem is that it's over $10,000. Now, if that's the $12,000 is American, yes, that's a big problem. Not really a big problem, but it means another
Reporting.
return you have to do, and it's called an FBAR. You hear us talking about this all the time. The Foreign Bank Account Reconciliation. It's a return called the FinCEN 114, and you have to report all your income that you
So it's
have.
like a fishing return. A fin.
FinCEN.
It's got a fin.
Yes.
No.
You're sinning because you have a fin in a different country.
Yes.
You have to report it anything over $10,000 in a different country. And yes, Canada is a different country, even though it's right next
what's
door to us.
Further complicates it, if that's 12,000 Canadian, when he does the exchange rate, maybe it's
under.
9,000.
That's what I was
Right.
saying.
I'm
Yep.
sorry.
That's what. Because that's why.
So if
you're-
it's under
10
10,000 US,
US.
he doesn't have to do it,
correct.
right?
Yep.
So really he would be exempt if this is 12,000 Canadian until the exchange rate gets higher. Then he'd have to do the FBAR report. Now it's a simple report to do, right?
Yes.
But the penalties are very stringent. The penalty for failure to file the FBAR is 50% of the value of the account, up to $10,000, whichever is greater. So that's a lot.
That's
of
a
money.
lot of money.
So again, if you are a U.S. citizen with income in any foreign country, excuse
Then-
me,
Important that you have this conversation.
Yep.
And, yep. You have to do the FBAR potentially.
give us a call. We'll help you through it. We do these all the time for people. My explanation for this is not the IRS. The government has always gone fishing. Speaking of fishing, for the marlin, the grand prize, and what they're doing is they're catching all the little minnows, all these little people like Brian, right? Donald. Sorry. Who only has $12,000 in their little nets. So unfortunately, they're getting all these little. But that's where they're going to make all this money.
They're probably getting some big fish too,
right? But
because the big fish would really have. I mean, basically, let's face it, Chris. We appeal to the little fishies, right? I mean, a lot of the little fishies who don't know any of this stuff are being taught by us.
Right.
Thank God. I think that's one of the benefits of Ask the Tax Lady is that we try to get you guys to know stuff that only somebody who's extremely expensive would tell you.
That's right.
And so that's part of what we love to do here on Ask the Tax Lady is we get you to know. So like at dinner parties, you can say, oh, by the way, I didn't know that I had to do a special FinCEN report because I had money in Canada. You know, one of my clients this tax season said to me, you know, this is crazy. I don't want to do this stupid report. I'm just going to take my money out of the bank in Canada because she says I just kept it over there just in case, you know.
Yeah.
So, and it becomes kind of a nuisance thing, and that's kind of what happens. I'm Esther Golias, the tax lady from EG Tax. Today we are just answering your email, so we're not taking live phone-in calls. We will next Saturday, and we're going to take a short break right now for news. We'll see you on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. We're answering your emails today, so we aren't taking live phone-in calls. We will be back next week with our live phone call segment per normal. But it's interesting, I think, for you guys to hear us kind of chew up the tax law because we get to say things more in depth with this kind of a format. The other thing is, if during the week or any time you have a tax question, you can go to our website at egtax.com, and there's a section on there, Ask the Tax Lady, and you can put your question in, and no matter what time of day, we will answer it. And there's no charge for the service. And during the week, where our corporate office is open 9 to 5, Monday through Friday. Our branch offices are closed this time of year, but we are there to help you if you haven't filed your return, or if you got letters or anything like that.
That's right.
All right, let's go back. And I'm with Tiff Fabian and Christopher Fabian.
That's right. And
I must have really boring conversations at home. Since you're both in the tax business. All right, go on.
Joe, our poor kids. Joe from Cheektowaga. He writes, my son's girlfriend has been living with us for 2 years. She is 17, works a part-time job at a fast food restaurant, but pretty much we pay for everything else. A friend of mine says she's our dependent. Is that right? Well, I'm going to chime in and start by saying most likely it sounds like it. Chris?
I mean, there's a lot more questions that got to go involved. Are you getting support from her parents?
I mean, it sounds like not.
Right.
I mean, based upon the limited, there's a lot more questions you got to ask, right? But number one, if the non-relative, it's a non-relative,
right,
is living in your home for 12 months
correct,
out of the year, and the non-relative has gross income of less than $4,000, and you're furnishing over 50% of their support, and they're a U.S. citizen, and obviously there's residing here, then they would be your dependent, right?
Right. That's right. And so as Chris says, you want to find out if that 17-year-old, if her parents are giving her money or paying for her car loan or car insurance, providing her funds.
Where are her parents?
Yeah.
I mean, did they move away and they wanted her to finish her education up here, so that's why you took her in? So, I mean, we got to dive more into it.
I mean, many times what happens is, teenagers have fights with parents,
mm-hmm,
and they left home, So
right,
that's a possibility. But it sounds to me,
at
first blush, that she probably is your dependent. Yet she lived there for a full 12 months the previous calendar year. You probably should amend your tax return and put her on. Now, what happens if, let's just say that there was a fight with her, mm-hmm, mom and dad, and let's say she's making $2,000 working at Burger King or something, and this couple is giving over 50% to her support, and the parent, they go to file on the return, put her on, and they say she's already been claimed. Would you suggest that they don't claim her?
No. I would suggest that they would claim her. They'd have to do a paper return and not an electronic return. And so they would claim her. And at that point, when the IRS gets, two people trying to claim the same person, the IRS is going to step in and ask for the person who provides the support to furnish proof of this support. And so there's going to be some due diligence and homework on the person who wants to claim her, but I wouldn't let this one go. What do you think, Chris?
Right. I mean, you got to get the proof of residency, first of all. Hopefully she changed her address at the doctor. She changed the address at the school. I mean, that's the most important thing, first of all, is you got to prove that she's lived with you for those 12 months.
Right.
And then you got to prove support. You got to,
Now, when she was 16, would they get the child tax credit? No.
No.
Because she's a non-relative.
Yeah, that's right.
Unless she was a legally placed foster child, right?
Yep.
They couldn't get the child tax credit. So really, when you're thinking about it, this $3,400 deduction, if they're in the 10% tax bracket, it's going to only save them like $500. They really have to say to themselves, do I want to do it? I mean, $500 is nothing to sneeze at,
Right.
right? But
pretty soon that 17-year-old will be in college, and that $500 could go to 20.
That's correct. That's correct. So that is true. But I think a lot of people say, "Oh, this just sounds like too much work for me," and it really isn't. I mean, if she truly is living in your home, it ought to be pretty easy to prove.
Yep.
Right. Okay. What else we got?
Dear Esther, I just started a new job, and my boss told me that I should file single with 10 exemptions. I am single, 25, and don't own a home. How can I do this? And that's from Bob.
I don't think
I
that's
think
a
Bob
good idea.
needs to go talk to his boss,
That's
and his
not-
boss better take a tax course.
Right. When you do 10 exemptions, that means that there's not going to be much withheld for the IRS, and so you're going to get more in your paycheck. And as a single guy, 25-year-old, he doesn't own a house, he doesn't have a lot of write-offs. That means at the end of the year when he goes to file his return, he's going to be way short because there wasn't much for withholdings. And, of course, there was more in his paycheck, but he's going to be significantly
Well, I mean,
short.
his tax bill is going to be about $1,500 after a standard deduction and
Right.
personal exemption, right? So that means that next tax time he'll owe about $1,500 if he doesn't. So that's not such a good idea. So every time when you fill out your W-4, the more allowances you claim, the less they take out of your paycheck, and the less goes to the federal government. At 10, you're not going to have anything withheld. That means at tax time you're going to owe $1,500.
Right.
Anything over 1,000, you're going to pay a penalty.
Right.
So your boss really has not informed you properly, and I would suggest that you claim at least, I would say, no more than 2.
Right.
I had
Two
a-
to
wants to
break
be
out
flat.
even, one to
Right.
gift you.
I had a client this year. Her daughter was getting married, and so she switched her exemptions to 10, and she forgot to switch it back. And so we sat down and did her return, and she was like, "Oh my God, I forgot about switching it back." And so
And that's what happens. That's what I was going to say. Well, people play with their exemptions. Oh, I'm getting a big bonus check, so I'm going to claim 0. So I get, or 10, so I get all my money, and then they forget to change it, and they come in, and then we say, well, you owe money this year. But how? I always claim 1 or 0. This is, well, they only withheld $2,000 on $40,000
Well, or
worth
maybe
of
you work
income.
that part-time job, and you're making $75 a week, maybe part-time, maybe as a server, and you have another job where you're making $50,000, and they're taking nothing out of that serving job. But at the end of the year, it's like $4,000 extra that you made at maybe 15%. That's $600 that you're going to end up having to reduce your refund by or pay an extra taxes. So to get back to our question, Guy, I would suggest no more than 2, 1 to 0 if you really want a refund.
Right.
Okay?
I concur.
All right, what do we got?
I got Tom in Blaisdell. He writes, Tax Lady, since Buffalo real estate is so desirable right now, I'm thinking of buying a house to flip. Just what is deductible for me? My labor, my time. Is this self-employment income? Is this a good thing to do? What is your opinion?
Okay. Well, first of all, if he's just going to do one house to flip, a house is a capital asset, right?
Right.
So it's going to be the sale of a capital asset, and either it'll be long or short term. So if he holds it for less than a year or less, then it's going to be a short term capital gain. I'm assuming it'll be a gain.
Yep.
And he's not going to be self-employed. However, like if you see some of these places, like these shows on Better Homes and Gardens, where these people, that's all they're doing is buying and selling and buying and selling, and they got multiple houses going on. That is a business. If that's your primary source of income, and that's what you're doing, flipping houses, then you move from a sale of capital asset to a Schedule C, right?
Right.
And so at that point, his labor he couldn't write off, and he couldn't write off his time, but he could write off travel and other expenses associated
with everything
with
affiliated. If it's ordinary and necessary to make the house so that he can sell it, it's going to be deductible. That would include his utilities, the tools that he buys, advertising that he does, to sell it, the brokerage commissions if he has it listed with a real estate company, the materials, the supplies, the windows, the air, everything that goes into that house that's ordinary and necessary, and then that all comes up to an adjusted cost basis. Right. Let's say he buys the house for $100 and he puts $50,000 into it. Then the adjusted basis is $150. If he sells it for $200,000, he's got a $50,000 either long or short-term capital gain.
Now let's dive into that a little bit more. So he's making $50,000. What's the difference that he's going to save if he holds on to it for an extra 2 weeks to make it a long term compared to a short term if he sells it right away?
Because if it's a short term capital gain and he's in a 25% bracket, he's going to pay 25% on that $50,000.
Right.
However, if he's in the 25% bracket and he holds on to it to another 2 weeks, 15%. He only pays 20%, right? So he'd save 5%. Pardon me?
15%.
He's in the 25% bracket.
So his long-term capital gains is 15%.
Okay,
I
you're
thought
right.
it was
You're right.
15 too.
That's right. It'd be zero otherwise. I'm thinking of zero. Right. So 15%. So he'd save 10% on the 50 or $5,000.
Oh,
That's a big change.
Big
I
change.
could wait 2
I
weeks for that.
I would say to my
Lawyer,
broker,
stall it.
that's right. Really, if you bought the house, let's say July of 1 year, and here it is June, and you got a contract, I would put in the contract you have to wait till July, the whatever date it has to be, in order to make it come out.
Yep.
Makes sense
that's
to
where
me.
the tax planning
That's
really
what
all
Esther
comes in.
started
Right.
talking about.
Right.
Yep, at the
Correct,
top
correct.
of the show.
Okay, what else we got? A quick one before
I
our
got
break.
Esther. I just started a new job. Oh, I read this one already. Tax lady. My company just told me that the pay would be increased by $500 a month to help me cover for my expenses. Should I change my withholdings to cover the $6,000 increase in my pay? And so this, I think, has to do with an accountable and a non-accountable plan.
Yep.
And go on, Chris.
No, you don't have to, because what they're doing, they're giving you the money, which means it's an unaccountable plan, so you don't have to turn in your mileage logs anymore. You don't have to turn in your entertainment fee, anything like that. They're just giving you $500 a month. So anything you spend will be deductible on a Schedule A through the 2106. So if you drive 25,000 miles a year, that 25,000 miles times the 56 cents a mile now would drop down, so you're getting a huge write-off on your tax return, so that's going to cover that extra income that's in your W-2.
Provided they put it in the W-2. You know what I see a lot of times, Chris,
Cutting a check.
is that you get somebody on a non-accountable plan and they don't put it in the W-2. Because many times you're dealing with small employers who don't know what to do.
Yep.
So you really always have to say, is this in your W-2? And if it wouldn't be, then it would be a subtraction on the 2106.
Right.
And the extra money that she would get, assuming it's going to be offset by the employee business expenses, I would think she doesn't have to change her withholding. Do you?
I would think not.
I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break. We'll be back on the other side with more of our emails. See you on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. This week is our email answering show, so we are not taking live phone-in calls. We will next week. If you, of course, have any questions during the week, you feel free to call us at our corporate headquarters, and you can always also go to our website at egtax.com, and there's a section on there, ask a tax question, and we'll be very happy to answer your question. But I think it's kind of a neat thing to be able to really pick each other's brains, right?
Definitely.
Okay, what do we got? What else?
I got Bernadette, and she writes, tax lady, my son is in debt up to $75,000 with student loans and makes about $20,000 a year. I have room on my home equity line of credit to pay it off. If I were to do this, can I deduct the interest on my return? Well, before we even answer her question, I'm thinking that he should call his student loan holders and check about income-based averaging and try to handle this himself is what I instinctively
right, because his income's so low.
Right.
And so when they change the loan repayment, it really doesn't change the amount due, though. And what it's doing is kind of just making the interest get bigger and bigger on the debt, right?
Right.
I mean, so what you're saying is absolutely correct. If he's trying to look for relief on the repayment as far as monthly, but it isn't helping the loan.
Right.
Right.
That's right. But if he was working for a non-for-profit agency.
All right. And that's what I wanted you to get into.
Right. If he was working for a non-profit agency and he called them and said, this is my situation, and they put him in an income-based situation, after 10 years, whatever wasn't paid off is in essence forgiven. And so I think that's what you were hitting on.
Right. You don't even need Bernie Sanders then. Do you?
Right.
So here's the thing. Working for a nonprofit, a hospital's a nonprofit.
Right.
The city of Buffalo is really a nonprofit.
That's right.
No, city of Buffalo. Working for a municipality, New York State, right?
That's right.
All of these, any job that your child or you get working for a not-for-profit, you just then have to go to Nelnet or whoever's holding your student loan and say, hey, I'm working for a nonprofit. Then what they do is they get you signed up. 10 years of on-time payments, and at the end of 10 years, that student loan is gone.
Oh, right.
And so if you go to an income-based repayment where it's true the interest is accruing, at the end it's not going to be, it's going to be gone anyway.
That's right.
And 10 years, for those of you that say, oh, yeah, but 10 years, that means I can't change jobs. That doesn't mean that, does it?
No.
You can go from Brothers of Mercy over to
New York State.
ECMC.
Right. Just as long as you stay with a not-for-profit, you're in good shape.
That's right. Now, had this not be, what were we going to say?
I have a client that actually is in an income-based repayment plan, works for a non-for-profit, and his student loans are about $150,000 to $200,000. And he got married in the process of doing this, and they file separate.
Right.
And at first the wife was like, "Oh, I don't want to do this. We're losing money." And I put the pen to paper, and I said, "Well, okay, you're losing $1,000 a year on your tax return, but in 10 years." He's not going to have to pay back $125,000. And she goes,
that's,
oh, you could see the light bulb going on.
And that's the whole thing about taxes. And that's what we're trying to get people to understand, is just because it is good for your tax return doesn't mean it's good for your finances.
Run.
I mean, you don't want to base all your decisions on, am I going to save taxes? Because the taxes are a teeny bit of the whole piece of the puzzle. Obviously, you put it into it's like making stew. You're putting all kinds of ingredients in, and it's an important ingredient, your tax portion. But you want to be smart. It's all about your finances. And I have to say, as things unravel here in the United States, I'm going to call it unraveling, you're finding people really have to get more creative because it's so much more confusing with student loans and Obamacare and welfare and earned income credits and all these things. It isn't just like it used to be. It's all different.
That's right.
Right.
That's right. You got a question there,
Well,
Kristen?
now let's
sorry.
go back to the other part of this
Yeah.
question. If she were to pay off the student loan with her home equity
Okay.
line of credit, can mom then deduct the interest?
Sure she could.
Well, as long as mom is paying.
And
Right.
she has to be a co-signer on the.
No, this is just
She's
on a
gonna-
home
she's
equity.
gonna-
Oh, on their home
so
equity.
the mom's going to be a real sweetheart and do it. And yeah,
Yeah.
and if mom takes her home equity and mom's making the payment and mom itemizes, yes. But that's a lot of ifs.
But
It
what
is.
I was saying is, could mom take the student loan interest deduction? Is what I was saying, which is a small little
Not
tiny.
if she pays it off with the home equity.
Well, if she was a signer on the loan, whatever interest.
No, but if the mother pays off the student loan with the $75,000,
interest-
there is no student loan anymore.
well,
it's
up to
now-
that,
it's
yeah,
all home
if
equity.
There was any right.
But I'm saying the interest that mom paid off that year.
If they say there was in that buyout there was $300 worth of student loan interest.
if mom
in the
was
payoff.
a co-signer on the
Yeah,
loan
right.
and paid it, I know
Right.
that's negligible.
But if-
And mom's income was low enough. And
But if
all
mom
that
is
stuff.
doing it, and that's what you got to look at. Maybe it's them themselves. Maybe, and let's put it on a couple that just got married and they have equity in a house. If they're paying 8% interest on a student loan and they can get a home equity loan for 3%, it would be better to do a home equity loan because, first of all, your student loan interest is limited to $2,500 as a write-off compared to your home equity. If you're itemizing already, would already
unless
be,
you're working for a not-for-profit, right? And again, it has to be like where you are in the student loan process. Let's say that you were working for General Motors and you've been paying down your student loans, and now you only got $3,000 left. Well, then you just want to get rid of it.
Yep.
But if you just got out of college and you got $100,000 worth of debt and you're working for Millard Fillmore Suburban or something, then that's different. You might want to go to the 10-year forgiveness.
Absolutely.
All right,
A
but that's
lot.
that's a
consider.
lot to digest, right?
Yeah, that is
Okay,
a lot.
what else we got here?
Linda writes in from Clarence. My mom just passed away this January. We now have to sell her house. She had put it in our names on the deed in 2000 when my dad passed. Do we have to pay the taxes on this sale? If so, how much?
Okay, well, so it sounds like she put their names on the deed after the
Right.
death of Dad.
So that's a
So
half.
that would mean that, yes, they have to pay taxes. The benefit they're going to do is they'll get a stepped-up basis for 50% for Dad's portion at least.
Mm-hmm.
And then Mom's portion, the other half, goes all the way back to what Mom paid for the house plus improvements.
Right.
So how much? And then it'll be subject to capital gain.
So to break this down, what you're saying, if you inherit something, you get the stepped up basis and
the whole thing.
And now in this situation, for part of it, it was gifted to them prior, and so anything that's gifted to you goes back to the original basis. So what Esther's saying is half has stepped up and half goes to original basis.
Right, because the mother had inherited the father's portion, and the mother then had the stepped up basis on half. And then once Mom gave it to the kids, then this half was stepped up and half went back to original basis.
So if A equals B and then C minus D times the square
So
root of pi.
What I want to say here is it's really important record keeping. It's really important that that the family goes and looks at all of the improvements that Mom and Dad did on the home, new roof, addition to the house, driveway, and
Kitchen, windows,
right?
right?
And so all of those things are going to increase that other half that goes back to the original basis.
Yeah, what I like to do is walk through the house in my mind with my
Right.
clients. I'll say, okay, we're standing outside. Did they do new landscaping? Did they put on a garage? All right, here we are at the front door. Did they change the doors
Siding.
and windows? Let's go in the kitchen. Is there a new kitchen? Did they redo the living room?
Right.
You walk through the house. How about the bathrooms? The basement, the electrical? Did they put on a room addition?
That's right.
All that kind of stuff.
It's a lot of, and a lot of times people don't
All
think.
right, and then the other thing that you just brought to mind is we all are getting older,
Right.
And so part of what you want to do is make sure now while you have, because getting older is an inevitability. Sit down one day and just write up what you have in your house and where your assets are and what your passbook numbers are and what your passwords are, and so that in the event that something happens, and it's whether it's a timely or untimely death, that your family has a handle on this so that they aren't stuck paying the taxes or not knowing where the assets are.
That's right.
Right. So New York State doesn't hold on to it for 5 years, and then all of a sudden you find your name on lost funds.
Right. That's right.
I know. I was with my girls yesterday, and we were in a nursing home, and they're younger, and they're like, "Oh, I'm never going to take care of you in this situation," and they're sitting there nudging each other. But when you're that age, you don't think about the time.
Hey, I remember when I thought 40 was old.
Yeah.
Now I look at 40s as 40-year-olds as youngsters, so it's all relative. All right, we got a quick one here before the end of the show.
This year when I filed my taxes, I had to pay a penalty for not having health insurance. But then my friend told me that I didn't have to pay the penalty. Is that true? How is that possible?
Oh, boy. Geez, with a minute and a half to go. All right, so with Obamacare, it's true that starting in 2016, the penalty is 2.5% of your MAGI, and it has to do with the number of family members in your house, and it can be very complicated. But if your income is low enough, or if the wages that you have are low enough compared to what your employer is offering for the plan, you may get out of the penalty, right?
Right. There's tons of exceptions to the penalty. So if you paid a penalty this year, give us a call, 632-7886, and we'll work out with you to see if you should have paid that penalty or not.
And we'll amend the return and get you the money back. Well, I'm Esther Gulius, the tax lady from EG Tax. If you have any tax questions during the week, give us a call at our corporate headquarters. Go to egtax.com, ask the tax lady, and we're very happy to help you. If you're getting love letters, bring those in. If you haven't filed, we can help you. Until next week, I'm Esther Gulius with Christopher Fabian and Tiffany Fabian. Have a great week. Bye-bye.